Hello everybody, my name is Pondisipewa and today I'm going to spotlight great value companies that can withstand inflation and possible rate hikes. As fundamentals are very important, so I will avoid companies that has persistently presented lower profitabilities. Investing was great last year. The S&P 500, Nasdaq and Dow Jones all outperformed, with Dow Jones enjoying its best year since 2000s. While growth investing has been trending lately, thanks to Katie Wood, but this year is the year to invest in value companies that will gain higher interest rates. Fundamentally, value companies has been identified as buying low and selling high. Reasons to invest in value companies: price to earnings, yield, and other indicators are used to identify value companies. Over the previous decade, growth has outpaced value, but last year, value outperformed growth. Investing in cyclicals, energy, real estate, and finance looks to be favored in 2022. These industries can absorb increased rates, while tech companies are traded at an inflated price. Inflation benefits value stocks, like increase in interest rates. Inflation is less likely to hurt value companies, unlike tech companies that are known as growth companies. Since value are traded at a cheaper price than tech companies that are unprofitable and while are traded at a overpriced. Since value companies are cheaper than unprofitable tech companies, value companies have held margins and can hold expenses greater than tech companies. Value companies often have more stable margins and can handle growth expenses better than growth companies. Many non-S&P 500 companies are cheap. 4 of the 5 companies that we are going to discuss today are not in the S&P 500 and are traded at a very attractive price. Particular mega tech stocks are traded at a very expensive price. So let's have a look at 5 companies that are selling below their sector average value. So our first company today is PBR with a market cap of 79 billion.78, PE ratio 5.69. PBR is a Brazilian business that specializes in oil and gas. They drill and process crude oil, natural gas, and other hydrocarbons. This stock will gain from rising global demand for oil and other economic reforms. PBR surpassed its year estimate with 70% output of the total company. The future looks bright for this company with a gross profit of 58.62%. It has a forward PE ratio of 5.67, which is 56% below the sector average. The 2021 Q3 company earnings per share of $0.47 topped analyst expectation by $0.14. It is well positioned to benefit from sector profitability. Second company is Safe Bakers with a market cap of 435.7 million, PE ratio 1:28. Many businesses are experiencing shortages such as frontline workers, port workers, and truck drivers. Secure Backers is well positioned to rise due to perfect market condition and increased demand for cargo services. This company is trading at 86% discount to the sector. With the rising demand, the corporation is set for more remarkable years to come, with a forward earnings per share growth of 186% compared to the sector 12%. Bulkers are well positioned for the following reasons. China is leaving Australia, iron and steel in favor of Brazil. The order book is still small to the relative demand. Safe Barker is now trading at an exceptional discount, and it's a great investment for portfolio. Especially, it is well positioned for growth given its positive earnings. Our debt company is HPQ with a market cap of 40.74 billion, dividend yield of 2.73%, PE ratio of 8:77. To improve the way people communicate and do business, HP delivers the world-class computers and devices. The stock recently announced the dividend of 25 cents with a 2.73 annual yield. Many investors desire consistent dividend distribution, which is why HPQ is a great stock for preserving capital while achieving income goals. HPQ has a great reputation and relatively cheap valuation compared to others in the tech industry. By taking advantage of the present situation, HPQ has emerged as a strong competitor. Our food company is Cooper with the ticker symbol COOP, market cap of 3.32 billion with the PE ratio of 5:07. Our group offers mortgage finance and mortgage origination for single-family homes. Over the past 5 years, the COO has experienced a hike of at least 150% in the price. Despite S&P 500 falling 5.9%, COOP is up 3.3% because of the US housing market is still booming and it's likely to continue grow. COOP can leverage the present atmosphere, company growth and self-reinventation. COOP has tremendous years of profit with earnings per share of $2.42, beating 61 cents. Our feed company is Anderson with a market cap of 1.23 billion, dividend yield 1.29, PE ratio of 14:11. ANDE Rail, Blood Nutrition and Consumer Staple Firm. It is a great purchase after a good 3 quarters. Raised its quarterly dividend nearly 3%, highlighting the strength of their profit. With a strong demand and lower grain stock on their Q3 report, including new markets like renewable diesel and supply chains extension, agriculture is poisoned for long-term growth. A large grain harvest and higher agricultural demand should help the company grow. ANDE is well positioned for growth. With its diverse segments, Androsens has seen 50% price increase. ANDA price per sale is 92.83%, lower than the industry median, suggesting that the company is undervalued. This company is a consumer staple. Given the current situation of inflation, investors should look into investing in value companies, and they will profit from higher value prices and profits that these companies are going to make. If you like this video, please subscribe and watch other videos in this channel, and support me by sharing this video with your peers and everyone who likes videos like this.